Greeting for the day. I hope you are doing well. I am Manju Kaimal, Assistant Professor from the Department of Professional Management Studies. Today, we will be discussing the concept of discounted cash flow. Discounted cash flow is one of the pivotal model which is used in financial management for taking major decisions in finance such as investment decisions, dividend decisions, and financing decisions. Discounted cash flow model is a valuation approach which helps in making finance decisions. So how does DCF model helps in taking finance decisions? Since it is a valuation model, it helps in finding out the intrinsic value of a business, investment, or a project. So intrinsic value in DCF model is determined on the basis of expected future cash flows from that investment. So in order to arrive at that intrinsic value, we have to convert that future expected cash flows into its present value. So why we are converting the future cash flows into present values? So here we are taking investment decisions or any kind of financial decisions today by comparing the values with the future. That's why we are converting our future values into present values using a discount rate. That's why the underlying principle behind the discounted cash flow is the time value of money. So time value of money implies $1 today is more worth than $1 in the future. This is the foundation for discounted cash flow. Furthermore, we are discussing the application of discounted cash flow. We already mentioned that discounted cash flow is widely used in financial management for taking major finance decisions such as investment decisions, dividend decisions, and financing decisions. Specifically, we can use this DCF model to assess the intrinsic value of shares, bonds, and projects by using its expected cash flows. Secondly, it can be used to determine the worth or value of business or startup in case of any strategic decision such as mergers, acquisition, absorption, or amalgamation. And lastly, we can take capital budgeting decisions using this discounted cash flow. In case of taking any long-term investment decisions, we can use this discounted cash flow. So now we are going to discuss the concept of DCF model using a scenario analysis. So here the scenario is the investment decisions or capital budgeting decision. So a company wants to invest in a new manufacturing plant. The project requires an initial investment of $50 million and it is expecting a future cash flow over next 5 years. So the company wants to evaluate whether this investment is financially viable or not. So this is the situation. So here how we can give the solution to this question. So here we can apply this DCF model to give a solution to this question. So here we have discount rate as 10% or otherwise known as WACC, that is weighted average cost of capital. So here we are trying to figure out whether the investment is financially viable using the DCF model. So first we have to calculate the DCF value or the intrinsic value of this investment. For that we need future cash flows and the present value of future cash flows, terminal value and its present value. So here is a one table with 3 columns indicating the first one year. So we are expecting 5 years of cash flows. That's why 1 from 5. The next column represents the cash flow. So cash flow, free cash flow simply means the cash available to the equity shareholders. Or we can say it as the net profit after deducting the interest, tax, and also after considering the non-cash items. That is what is free cash flow. After calculating the free cash flows, we have to convert that free cash flows into its present value. So how we can do that? We can simply divide the free cash flows with its discount rate, and here that is 10%. So what is the meaning of that? So here, after the first year, that particular investment will earn a cash flow of $10 million. Okay. So what is the value of the 10 million now? That is the meaning of present value. So the present value of the 10 million now is 9.09. So we are taking the investment decision now. That's why we have to convert that future value into its present value. And that values are taken for the decision making purpose. So similarly, respectively, we have to calculate the present value for the entire 5 years. So we can take one more example. In the year 2, we are expecting 12 million cash flows from that particular investment. And the next column represents what is the value of that 12 million today. That is 9.92. And how we are arriving at that value? By dividing 12 with 10%, that is discount rate. So after arriving at the present values of all the 5 years, we have to take the aggregate of that. And we have to add terminal value along with this present value of cash flows. Terminal value simply means that is the forecasted revenue that can be generated out of that investment after the 5 years. So here we directly calculate the present value of terminal value, that is 182. And we have to add all the present values of future cash flows along with the present value of terminal value to get the DCF value. So here the DCF value is $238 million. And here, this is the time for taking the decision. So we got the DCF value. Now we have to compare this DCF value with the initial investment, that is 50 million. So after comparing the DCF with the initial cost, if the DCF is higher than the initial cost, which implies that the investment is financially viable. Otherwise, the investment is not financially viable. So here in the example, in the scenario, the DCF value is significantly higher than the initial cost, that is 50 million. So how we can take the decision? This investment is financially viable and we have to accept this particular project. This is the concept of DCF model. And here, this is the pictorial depiction of what is the discounted cash flow model. So simply, discounted cash flow model helps to determine the value of business. The value of business means intrinsic value or true value or fair value of a business, investment or a project. Then how we can arrive at the value of business? By considering the future cash flows. We have to sum up the future cash flows. It is not mere future cash flows. We have to convert that future cash flows into present value. So how we can take the present value? By dividing each year's future cash flows with its discount rate, we will be arriving at the present value of future cash flows. And after finding out the present value of future cash flows, we have to find out what is the terminal value. Terminal value means the forecasted growth of that investment after the specified period of that investment. And we have to again convert the terminal, because the terminal value speaks about the future value. So again, we have to convert that into present value. So by adding up or aggregating all this present value of future cash flows along with the present value of terminal value, we will get the value of business. This is how the DCF model works. So in conclusion, we can summarize that DCF model is one of the prime model which is helpful in taking major financial decisions such as investment decisions, financing decisions, and dividend decisions. I hope you understand the concept. Thank you.